In this video, I'll be showing you how to earn additional money via selling covered call options. The prerequisite for this video is to have watched my first video on how I earned my first $100 via options trading. This video is for educational and entertainment purposes only. Based on ChatGPT's reply, right, it is a type of financial contract that gives the holder the right to sell a particular asset such as a stock at a predetermined price at any time before a certain date. The person who sells the option is the writer and the person who buys the option is the holder. A little bit complicated, so I'll just break this down. I'll only be talking about selling options here. In this case, we are the writer of the option. The first step to selling call options is that you must have 100 of the stock you're intending to trade options on. In this case, I've chosen Apple for demonstrative purposes. The exact price of Apple right now is $129 on the 9th of January. And if you don't own 100 Apple shares, right, you cannot sell any covered call options. The total cost price of 100 Apple shares right now is at $129 times 100, which is 12.9k USD. When you sell a call option, you're essentially saying that you promise to sell 100 Apple shares at whatever strike price you chose, and this promise will be valid for X amount of days. Let's say, for instance, I choose a strike price of $153, which is highlighted, which has this yellow line over here. I promise to sell 100 Apple shares at $153, and this promise will be valid for 30 days. The reason why you must own 100 of the particular stock you're trading options on is because you're promising to sell. You can't promise to sell something that you don't have. Truth to be told, you can actually do that, but for beginners, I won't go into that because that is called a naked call option. For complete beginners, right, never sell a call option if you don't have 100 of the stock you're trading options on. Let's use another example, right? The stock here I'm looking at is Coca-Cola, and the stock price right now is at $62. Based on some very simple technical analysis, I'm seeing quite a clear resistance over here. It's around $66. Based on technical analysis, right, there is a chance that Coke will remain below $66 because every time it approaches about $66, it crashes down again. Every time it reaches $66, it crashes down again. $66 is more of a conservative approach because it's very far away from the current stock price. But if I were to just bring it down, right, maybe make it accurate, right, maybe the actual resistance line is at $64 because it hits $64 many times. So there's one time it hits it here, 1, 2, 3, 4-ish, 5-ish, 6, 7, 8. So you can say that this is probably a very strong resistance line that Coke has to break through. If I were to sell a call option on this stock, right, first steps first, I must own 100 Coca-Cola stocks first. I might take 6,200 USD to buy 100 stocks of Coca-Cola before selling call options on this. If you don't have 100 shares of Coca-Cola, right, do not proceed to sell call options. Let's assume that I have 100 Coca-Cola stocks. I want to earn additional income from it. So what do I do? The resistance line is right now at about 64, 68. I can be conservative and maybe raise it up to, let's say, $68 or maybe even $67. Let me choose a strike price of $67. Right now, we then go to the brokerage platform, click KO, which is the stock price of Coca-Cola, click on options chain, choose the expiration date, and this refers to the number of days the promise will be valid for. So most of the time, I will choose the expiration date of about 30 days. On this options chain table, right, there are the call columns on the left and there are the put options on the right. If I want to sell a call option for Coca-Cola, right, I'll choose a strike price of $67 and I'll click over here, sell. After that, I will then click order. Make sure you click on sell order, click on quantity 1. In general, I think market is fine for complete beginners, and then click preview. So that means I will earn an additional income of $23.82 USD. That is the amount that I will earn when I do sell call options for Coca-Cola. The $1 million question is, when do you want to sell a call option? You want to sell a covered call option when you do not expect the stock price to increase in the next 30 days or so. This strategy is ideal for investors who believe the underlying price will not move much over the near term. When you do sell call options, you're making the bet that Coke will not exceed $67 in the next 30 days. And if it does not exceed $67 in the next 30 days, you get to keep the cold hard cash of $23 in your brokerage account. You might be saying right now, $23 is very little. I do agree with that. $23 is very little. I'll take some time to explain the other factors that you should consider when selling call options or even put options. There's this metric here called IV, which is called implied volatility. The implied volatility of Coke is at 18.4%. In general, we only want to sell call options or put options when the IV on a particular stock is more than 30 to 40%. Because IV is called implied volatility, the specific definition of implied volatility is that it represents the expected volatility of a stock over a life of the option. When the IV is low, it means that the fluctuation of the stock price is not that aggressive. Whereas if you look at stocks like Tesla, the current implied volatility for Tesla is at about 80%. If you do sell a call option on Tesla, you actually earn a lot of money. So step 1 for covered calls, if I were to demonstrate using Tesla, first step is that you must own 100 Tesla shares. So whether you bought it a long time ago or are going to buy it now, it doesn't matter. You must own 100 Tesla shares. If you do have 100 Tesla shares, the next step is to sell call options. So maybe I bet that within the next 30 days, I don't think the stock price of Tesla will be above, let's say, $143. So now let's sell a covered call option. We can scroll down and find a strike price of $143. Be sure to click sell instead of buy, okay? Do not buy options. I'm only talking about selling options right now. If you were to sell one covered call option for Tesla, it will be worth $2.20 each. For one contract, it will represent 100 stocks. You take $2.22, multiply it by 100, which amounts to about $200. Let's check out how much we'll get. Click market order, click preview. This is very interesting. Your order is not accepted. In order to obtain the desired position, your equity with loan value must exceed the initial margins. I'm in a fake account right now, so unfortunately, I can't sell a call option. Assuming if you can sell one call option for Tesla at $145, you will earn about $222. If I were to simplify this in layman words, right, it will essentially mean that I promise to sell 100 Tesla shares at $145, and this promise will be valid for the next 30 days. And the main reason why you would sell a call option is that you're betting that the price of Tesla won't increase over the next 30 days. Moving on to some other common mistakes that people make when trading covered call options. They don't understand the risk. It's important to understand that covered call options involve risk, including the risk of losing the premiums if the option is not exercised, and the risk of missing out on potential gains if the stock price goes up significantly. This is actually the reason why I don't recommend beginners to sell covered call options. It's a little bit more risky. In the case where you sell a call option and if the option is exercised, it means that you have to sell your stock away. Let me give an example here. Let's assume that you have 100 Tesla shares. You sold one call option at a strike price of $130 and you gain $490. The expiration date you have chosen is the 10th of February. In layman terms, this simply means that you promise to sell 100 Tesla shares at $130, and this promise will be valid until the 10th of February. Now let's assume that on 10th of February, the price of Tesla on 10th of February is at $160 each. Assuming you haven't bought back your call options, yes, you can actually roll your options. Assuming you have not rolled your options, you would then sell 100 of your Tesla shares at $130 each. But the moment that you sold 100 of your Tesla shares on the 10th of February, you would have lost about $3,000 because when the person who has exercised the contract to buy 100 of your Tesla shares, he or she can sell your Tesla shares at $160 each because that is the current market price of Tesla on the 10th of February. And therefore, that person will earn $3,000. That's all for this very quick video on covered call options. In general, I don't really recommend beginners to sell covered call options because short-term price fluctuations will happen of the particular stock you're trading on. But nevertheless, it is something that you can still trade. And if the actual stock price is approaching towards your strike price, you can actually roll your option similar to what I covered in rolling a put option. So I'll cover how to roll a call option in this video. Be sure to watch it here and I'll see you in the next one.